how likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah, now that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right, okay? But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going. Okay.
Okay. So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's inevitable. Okay.
Yeah, and it will be soon because this thing is ripe as a beast.
Okay.
And we know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
What are investors missing right now, and what do you expect for the miners over the next 3 to 6 plus months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5-6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40-something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled plus in a matter of handful of months, and I can't have a sharp pullback? Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pull back into the high 60s. That's down in the lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move. We've had, silver dropped hard 1 week last week, okay, and some follow through this week. So prices only dropped for 1 week. But when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. But what I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price, and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum, and you got into what we call an oversold situation with only that one bad week, creating an oversold situation. Whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred. It was over. I don't care how bad that week looked. You didn't follow through in a sustained way after that. You started the turn. So even though it looked ugly, especially to price chart watchers, momentum says, no, you're through. You're exhausted on the downside. And I think that's where we are. And that's the nature of the sell-off you're going to be seeing in the future. It's not this 1 year wide range that silver had between May of last year and June of this year, where you could just draw a line through about $32 and it'd be above or below it for a whole year. Or gold, like 5 months, April through May, June, July, August, sideways recently. That's not going to happen anymore. We're now in an accelerated phase. And in particular, when this particular spread chart breaks out, it not only says is gold going to beat the S&P, but it means the money flow is really just beginning out of stocks into gold, which means what? The verticality we've seen in price lately in gold is just the beginning of that sort of verticality.
Where are we in your analysis in this bull cycle when you consider that the typical precious metals bull cycle does not last for just a year or two?
What might happen in the next year or two might be awesome, though. I think we're going to go into a new reality. Go to the next page, if you would. This is another spread that we're watching we think is enormously important. This only goes back to 2020. If you recall, in early that year, silver about doubled in price, went from like $15 to 30 in 6 months. A lot more than gold went up. So this spread went from 0.9% to 1.5%, which is, huge move. Silver doubled, gold went up like 40% or so during that surge. And then what happened after 2020, price-wise, late 2020, silver had bumped 30 area, and it went sideways to down while gold went sideways, okay? So on a relative basis, silver, that black line there, the black zigzag, is the price of silver divided into a price of gold, ounce per ounce. And silver went from 1.5% of the price of gold down toward 1% of the price of gold. So it's been an underperformer for all those years, though it's been going up in price, admittedly. Now, in the last handful of months, you can see that spread has shot up again, the top chart now. And there's a black line, a downtrend, that we bumped. And this month, we're backing off from it. So we've got a 3-point trend line there to focus on going forward. But we also have the green line. What does that say? That's a level where since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout. And we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum is already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month.
When you look at a market structure like this, a structure that practically shouts at you, it's hard not to get a little excited, because markets, when they build patterns this clear, this technically pristine, they don't do it just to tease you. They're building a base for something. And in my decades of doing momentum analysis, I've learned one thing. When a market spends months hammering on a ceiling, it's not because it enjoys the exercise, it's because it's getting ready to blow right through it. Now, people ask me, Michael, what's the probability that this kind of structure actually breaks out? And I always tell them, when it's this clean, this symmetrical, and when the underlying fundamentals are aligned, it's not a question of if it breaks out, it's a question of when. You don't build this kind of setup to say goodbye. You build it as a launching pad. And what we're seeing in gold, silver, and the miners right now looks like the starting gate of something that will redefine the entire financial landscape. I've been watching this spread, the relationship between gold and the S&P 500, for years. Nobody on CNBC talks about it. You won't find it in a glossy financial magazine, but it tells you everything you need to know about where capital is flowing. When gold begins outperforming the stock market, when that spread starts breaking above resistance, that's when you know a shift is underway, from paper assets to tangible ones, from speculation to preservation. And right now, that spread is right at the edge. It's nudging the door, testing the lock. And once it breaks through, it won't just be another move higher. It will signal that money is stampeding out of equities and into gold. And that's when the real vertical phase begins. That's when the crowd, which has been laughing at gold investors for the past decade, starts tripping over itself to get exposure. That's when momentum becomes emotion. And emotion is what drives the biggest rallies in history. Let me give you an example. Back in early 2020, before the world went mad, silver doubled in 6 months, from about $15 to $30. Gold, during that same time, went up about 40%. On a spread basis, silver jumped from 0.9% of gold's price to 1.5%. That's a massive move. But after that, both metals went quiet. Silver drifted sideways, gold went into a long consolidation, and people lost interest. Everyone said, oh, that was it. The metals had their run. Except it wasn't it. It was a pause, a digestion period before the next major leg. What's fascinating is that while the price looked boring, the momentum structure was quietly rebuilding. Momentum doesn't lie. It doesn't care about the headlines or the narratives or the talking heads on Bloomberg telling you the smart play is to chase the next AI stock. Momentum cares only about force and direction, and right now that force is pointing straight up. The spread structure we're watching, the ratio of silver to gold, is sitting just below a triple top breakout level at around 1.31%. That might sound like a trivial number, but in market geometry, it's monumental. It's the difference between a market that's trading and a market that's trending. When it breaks through that level, and it will, the entire dynamic of the metals market changes. Silver stops being the laggard and becomes the leader. And when silver leads, the fireworks begin. You can already see the tension building in the charts. Momentum has already broken out ahead of price. That's something we've seen before. In 1979, right before silver exploded to $50, and again in 2010 before its run from $28 to $50 in just 6 months. Momentum leads price. It always does. It's the shadow that tells you where the light is going. And right now that shadow is screaming, "Get ready." The problem is that most investors only watch price. They're staring at the daily charts like they're watching a heart monitor, and every tick makes their blood pressure rise. They see a pullback and panic, but pullbacks in bull markets aren't warnings. They're gifts. If you can't handle a 10% correction in a market that's doubled, you don't belong in it. Because if you want the upside, the kind of move that changes lives, you've got to sit through the volatility.
Ignore the sell-offs just look at a silly price chart of gold or silver. Just for example, back in, remember, silver was capped off at $35 October last year and March of this year, and was in a 1-year sideways range. And when it came back up through 34, we said, watch out, this time it's going to blow, but it's going to get more vertical. It's been a 50% increase in price since then, and 8 weeks prior to last week now, 8 weeks of higher highs, higher lows, 8 weeks in a row. I mean, that's highly unusual. Can't it have a break where it takes out a prior week's low? Is that really a disaster? Now, gold, which is interesting, last week, when silver took out the prior week's low, it refused to take out its prior week's low, so it had 9 weeks of higher lows. Today, finally took out a prior week's low. And it's the end of the world? Let it breathe, okay? It's an opportunity to buy if you're not already in. I don't see protracted congestion, which is what we had April, May, June, July. You know, at 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week. Okay, but right now we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it. Okay, now the only problem was gold hadn't taken out a prior week's low, and so we finally did. I mean, that means we got under 4,000. Okay, it's back above there now. I think the cleansing we just had is probably about exhausted. And that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so, okay? And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look for that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to the S&P 500. Okay, the biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay, since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure.
When I say this market is ripe as a beast, I mean it. We've been building toward this for years. All the conditions that fuel a generational move in precious metals are now converging. Rising debt, weakening currencies, global political instability, and, most importantly, the collapse of confidence in central banks. Every major shift in market leadership, from stocks to commodities, from paper to metal, begins the same way. Denial, disbelief, then panic. We're at the tail end of disbelief. The denial camp is shrinking. The mainstream financial world is starting to admit, reluctantly, that the old playbook doesn't work anymore. Let's look at what's happening in real time. The Fed is boxed in. Inflation hasn't gone away, despite the narrative. Debt service costs are ballooning. Every rate hike they implement hurts the real economy, but every rate cut they announce accelerates inflation and undermines confidence in the dollar. There's no exit, and markets know it. That's why gold is rising even when real interest rates are supposedly positive. The old models are broken. The relationship between yields and gold was based on trust in the system. The idea that higher rates meant discipline and sound money. But now everyone knows those rates are just window dressing on a bankrupt fiscal structure. Gold doesn't care about nominal yields anymore. It's reacting to real risk. This is what people miss. They think gold and silver are about inflation hedging. They're about trust hedging. They're about survival in a world where every promise made by governments and corporations is contingent on infinite borrowing. When you see the kind of technical structure we're seeing, clean breakouts forming beneath multi-year ceilings, you can bet that something deeper is shifting. I've been studying momentum for decades, and I can tell you this. Markets don't form this kind of setup in quiet times. They form it before paradigm shifts. And this isn't just about gold or silver. It's about capital rotation. The S&P 500, inflated by a decade of zero interest rate policy and cheap credit, is a bubble. Not a tech bubble, not a housing bubble, a monetary bubble. The spread chart between gold and the S&P is showing what comes next. The money flow is turning. That's what makes this so significant. The breakout isn't just technical, it's philosophical. Investors are saying, I don't believe the narrative anymore. So what happens when that momentum truly ignites? You get verticality. Gold doesn't grind higher anymore. It surges. Silver doesn't lag, it sprints. The miners don't just recover, they explode. And that's exactly what this spread setup is foreshadowing. When you look at the current charts, you see the same signature we saw in the late 1970s. Back then, momentum broke out ahead of price. Gold was still trading under $200 when the ratio chart started to show that something seismic was coming. Within 2 years, gold had gone to $850. Silver followed, violently. We're seeing the same conditions again. The silver to gold ratio is sitting on a triple top that's ready to break. When it does, silver will start moving not just faster than gold, but exponentially faster. And that's the moment that wakes up retail investors. The moment they realize silver isn't just an industrial metal, but a monetary one. And let me make this clear. Silver isn't just undervalued, it's suppressed. Years of paper trading, leverage, and derivative overhang have kept its price below fair value. But once confidence in the paper system cracks, the suppression ends overnight. The true price emerges. And it won't be pretty, at least not for the shorts. You can already see it in lease rates and supply data. Physical silver availability is drying up, even as the paper price looks calm. It's the calm before the hurricane. When paper promises fail and physical demand spikes, the repricing will be violent. And that's where we are now, on the verge of that repricing. The market's technical structure is screaming, launch. The macro environment is fuel-soaked, and the match is already lit. The next year or two, I believe, will be remembered as the phase where precious metals entered a new reality. A new price range, Gold won't trade in the thousands. It'll trade in the five figures. Silver won't trade in the 20s or 30s. It'll trade in the hundreds. And yes, I know that sounds wild, but so did $850 gold in 1979. Once the momentum structure breaks, and it's already halfway there, the move will feed on itself. That's how markets work. Price drives attention, attention drives buying, and buying drives price. It's a feedback loop that accelerates until the fundamentals catch up. As for the miners, the setup is astonishing. You have companies trading at valuations that assume gold stays at $2,000 forever. Meanwhile, their margins at 4,000 gold are astronomical. The revaluation hasn't even begun. Over the next few quarters, earnings will surprise to the upside, dividends will rise, and suddenly the sector Wall Street ignored for a decade will become the new darling. That's the irony of markets. They always overcorrect. They overhate what's about to soar, and they overlove what's about to crash. Tech stocks have had their run. AI might be the buzzword of the decade, but it's also the echo of the last mania. The next mania will be in real assets: gold, silver, uranium, energy, agriculture. Things you can touch, things you can't print. And when people say, "Michael, how do you know this breakout won't fail again?" My answer's simple. Markets don't build this kind of architecture twice. They don't spend years forming a structure this symmetrical just to roll over. Once it breaks for good. We're standing at that threshold right now. If we close the month above that critical level on the silver-gold ratio, around 1.31%, it's game on. Momentum will lead, price will follow, and what's coming will make the last decade look like a warm-up. For investors, the key is conviction. You can't trade your way through this kind of move. You have to own it. You have to understand what you're part of. A once-in-a-generation rotation from fake money to real value. So stay patient, stay disciplined, and don't let short-term noise distract you from long-term signals. The structures we're seeing don't happen often. When they do, they redefine everything. This isn't the end of the bull market. It's the beginning of its vertical phase. And when the history books are written, this will be remembered as the moment gold and silver stopped being assets and became money again.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.